What's driving these gains?
Well, there's a little bit of micro and a little bit of macro, at the risk of sounding like a song. I mean, the macro is some of it's global, and I do think the fact that actually we are nearing a resolution for the US shutdown has had a positive impact on markets across the globe. Plus, you've had things like the resolution on kind of Swiss tariffs this week, in the last week, which has also added some tailwinds to the European markets. You've also got expectation of lower rates. The ECB has been ahead of the UK and ahead of the US in its rate cutting cycle. But we've had poor jobs data that came out of the UK yesterday, which means the market is all but pricing in a certainty of a December rate cut. So there's been some macro news that has been really supportive, actually, of European stocks. I'm including Europe in that. Plus, you've had some really strong micro stories. So there's a couple of things at play here. In the last 24 hours, we've had some rumours about Louis Vuitton, the luxury stocks, expansion into China, and that really lifted the stock around 6% on the French exchange yesterday. Plus, you've had a really positive note around Novo Nordisk, the Danish company, which has lifted all healthcare stocks across Europe on the expectation that actually the outlook for healthcare in Europe is actually much more positive. And that's a sector that's really lagged over the last year. If you have a look at what's been driving a lot of European rally year to date, it's been very much defence stocks on the promise of spending and banking stocks because of the interest rate environment. And actually undervalued areas, what we like to call kind of quality staples, like healthcare, like utilities, been really undervalued. And this recent kind of market exuberance has seen those areas actually lift alongside. So it's been a much more kind of broader sector piece.
You're carving out, though, your bullishness out of the UK. Why?
I think this is a really balanced story here. So if you think about the FTSE 100, 75% of the revenues come from overseas. So it's really not a domestic play. The one caveat to that is, though, and we've seen this in the US as well, when sentiment is really bad, it does affect the market, because actually if you're an international allocator, you're thinking, do I put money somewhere that does have political and macro uncertainty? And we had some results out from Taylor Wimpey, the house builder, this morning that showed that actually people are putting off buying houses in expectation that there may be something in the budget, the UK budget that's happening at the end of this month, that is not supportive for that sector. And we are seeing actually that caution across the piece in the UK. Now, if you are the likes of Diageo, which has got a great new chief executive, and you've got global revenues, maybe what happens in the domestic market politically doesn't have a huge impact on you. But if you see increases in corporation tax, in income tax, that does affect you. It does affect your potential consumers. So there is a potential sentiment there. That said, a lot of that negativity is priced into the market. So it's a fine balance on what are the impacts of the budget going to be on UK corporates. Is that priced in? And could this be a buying opportunity, despite all-time highs?
In the US, we're seeing a lot of optimism over U.S. equities and the future of AI and the economy more generally. So there's sort of a risk-on mentality. Are you seeing that with your clients in Europe?
I think the flows, if we look at our platform, they have been very AI-focused. They have been very tech-focused, really over the last 5 years. The last couple of months, we have seen our clients affected by the fears of a bubble. And we have been encouraging people to take actually some gains, because even at the times that AI has drawn back, you're still sitting on some really great returns over the last 5 years. And actually using this as an opportunity to rebalance a portfolio is no bad thing. Do we think that the US still has a very important part to play in in investors' portfolios? Absolutely. It is the dominant market, and we do think there's still some to go in that area. But this could be a great opportunity to diversify. We've been looking at emerging markets, actually. So, actually there's some positive momentum in emerging markets. India has pulled back. There could be some upside with India. Collectively, we do think that there's some opportunities in emerging markets because of the weak dollar. And we do think there's some areas in Europe and the UK that, as I said, have really lagged the rally. So things like healthcare, things like utilities, things like consumer staples, they've really lagged compared to defence, and compared to banks. And there could be some active stock selection, whether you outsource that to a fund manager or do that yourself, where there are some good value opportunities.